A Bitcoin ETF, or exchange-traded fund, is a way for people to invest in Bitcoin without actually owning it. Think of it as a bridge between the world of traditional investing and the world of cryptocurrency. Instead of buying Bitcoin directly from a crypto exchange, you can buy shares of a Bitcoin ETF on the stock market, just like you would with a stock or a traditional ETF. Here's how it works. A Bitcoin ETF tracks the price of Bitcoin. When Bitcoin's price goes up, the value of the ETF goes up. When Bitcoin's price drops, the ETF value also drops. This gives investors exposure to Bitcoin's price movements without the need to deal with the challenges of owning Bitcoin directly, like managing digital wallets or worrying about security risks. For example, imagine you want to invest in Bitcoin, but you don't feel comfortable setting up a crypto wallet or navigating a cryptocurrency exchange. Instead, you buy shares in a Bitcoin ETF through your regular stockbroker. You get the benefits of Bitcoin price movements, but everything is handled through the traditional stock market system. There are two main types of Bitcoin ETFs. Physical Bitcoin ETFs. These hold actual Bitcoin. When you invest, the ETF provider buys and holds real Bitcoin in storage on your behalf. Futures-based Bitcoin ETFs. These don't hold Bitcoin directly. Instead, they invest in Bitcoin futures contracts, which are agreements to buy or sell Bitcoin at a set price on a future date. Currently, most Bitcoin ETFs available, especially in countries like the United States, are futures-based. These are regulated, which makes them more accessible for investors who want to avoid the risks of directly owning Bitcoin. So, why would someone invest in a Bitcoin ETF instead of buying Bitcoin directly? There are a few reasons. Ease of access. Investing in a Bitcoin ETF is as simple as buying a stock. You don't need to create a crypto wallet, remember complex passwords, or worry about losing access to your Bitcoin. Security. A Bitcoin ETF is handled by regulated institutions, which reduces the risk of hacking or theft compared to directly holding Bitcoin. Tax advantages. In some countries, trading ETFs may have more favorable tax treatment compared to directly buying and selling Bitcoin. Integration with traditional portfolios. A Bitcoin ETF allows investors to include Bitcoin exposure in their existing investment portfolios, alongside stocks, bonds, and other assets. But there are also downsides. Bitcoin ETFs usually come with management fees. These fees are small percentages of your investment that go to the fund provider for managing the ETF. Over time, these fees can eat into your profits. Also, futures-based ETFs may not perfectly track Bitcoin's price, which can lead to slight mismatches in performance. Let's break it down with an example. Imagine Bitcoin is priced at $20,000 per coin. You want exposure to Bitcoin, but instead of buying an entire coin, you invest $1,000 into a Bitcoin ETF that tracks its price. If Bitcoin's price rises to $30,000, the value of your ETF investment also increases, giving you a return based on that price movement. But you don't need to own any Bitcoin yourself. Your investment is tied to the ETF. However, remember that investing in a Bitcoin ETF is not risk-free. Bitcoin's price can be very volatile, meaning it can rise or fall significantly in a short amount of time. If the price of Bitcoin drops, the value of your ETF investment will also drop.